Welcome back to PyUncut, your go-to source for deep dive investing insights and data-driven stories from the world of finance. Today, we're talking about Capital One Financial, ticker symbol COF, ahead of its upcoming quarterly earnings report. Wall Street analysts are predicting mixed results. Earnings per share are expected to dip slightly, but revenue is set to surge nearly 49% year over year. So what's really happening under the hood of one of America's biggest consumer and credit card banks? Let's unpack the key data, what it signals about the broader economy, and whether investors should pay attention before the results drop. Setting the stage, the big picture. Capital One is often seen as a bellwether for consumer credit health in America. It's not just a credit card issuer. It's a hybrid bank that operates across consumer banking, commercial banking, and credit cards, both domestic and international. For the upcoming quarter, analysts expect earnings per share, $4.23, down 6.2% from a year ago. Revenue, $14.9 billion, up a massive 48.8% year over year. That's an intriguing combination. Falling earnings, but skyrocketing revenue. Why? Because rising funding costs, higher loss provisions, and spending on technology and marketing are eating into profits even as card balances and interest income expand. It's the same story we've seen across much of the U.S. consumer finance space. Demand is high, but risk is rising too. Analyst Revisions. What Wall Street is signaling. One of the most important clues before earnings day isn't the number itself. It's the trend in analyst estimates. In the last 30 days, the consensus EPS estimate for Capital One was revised down by 2.2%. That may not sound like much, but it often signals that covering analysts, those who talk directly with management and track consumer data, are growing slightly more cautious. Historically, earnings estimate revisions tend to correlate with short-term stock price movement. In plain English, if analysts cut their forecasts going into earnings, there's often more downside pressure in the near term unless the company surprises big. So, this small revision matters. It shows investors are bracing for potential credit-related headwinds or margin pressure despite healthy top-line growth. Deep dive. Business segment breakdown. Let's break down the key business lines and what analysts expect for each. Commercial banking. Projected revenue, $1.02 billion. Year-over-year growth, plus 15%. Commercial loans continue to show moderate growth as small and mid-sized businesses draw down credit lines amid higher rates. Capital One's commercial arm remains a stable, less volatile contributor to earnings. Consumer banking. Projected revenue, $2.79 billion. Growth, 26.3% year over year. That's strong growth, showing that retail deposit and consumer lending activity remains robust, even with inflation squeezing disposable incomes. The company's push toward digital-only banking and improved mobile experiences is paying off here. Credit card. Domestic. Projected revenue, $10.66 billion. Growth, 55.1% year over year. This is where the real story lies. A 55% surge in domestic credit card revenue signals one thing. Consumers are borrowing and spending more, and Capital One's interest income is ballooning as rates stay elevated. But this is a double-edged sword. Rising balances means rising delinquency risk if the labor market cools or if consumers start struggling with debt payments. Credit card. Total. Projected revenue, $11.3 billion. Growth, 55.8%. The international segment adds a small bump, but the bulk of the business remains domestic. For investors, this shows Capital One is heavily tied to the U.S. economy, and that makes its performance a proxy for consumer credit health overall. Margins, efficiency, and risk metrics. When it comes to banking, profitability isn't just about revenue, it's about how efficiently you manage costs and credit risk. Let's talk numbers. Efficiency ratio. Expected at 54.1%. slightly higher than last year's 53.1%. A higher ratio means the company is spending more to generate revenue, possibly reflecting ongoing digital transformation costs and inflation-driven operating expenses. Net interest margin, NIM, forecasted at 8.2%, up from 7.1% last year. This is a big positive. It means Capital One is earning more from the spread between what it pays on deposits and what it earns on loans, largely thanks to higher Fed rates. Average balance of interest-earning assets, expected at $577 billion, up from $454 billion last year. That's a healthy jump of over 25%, showing that the bank's balance sheet has expanded significantly, fueled by credit card growth and higher consumer balances. Net charge-off rate, expected at 3.1%, down from 3.3% a year ago. That's a good sign. Despite a shaky economy, Capital One appears to be managing delinquencies relatively well. Net charge-off rate credit card, forecasted at 4.7%, down from 5.6%. Another positive indicator, though it could also reflect temporary strength in consumer repayments rather than a long-term trend. Tier 1 leverage ratio, 12.1% versus 11.6% last year. This means the bank's capital position is strong, giving it flexibility to handle volatility or continue buybacks. Total capital ratio, steady at 16.6%. Capital One remains well capitalized under Basel III guidelines, a comforting signal for long-term investors. What the market is saying. Despite all the positive balance sheet trends, COF shares have fallen 4.7% over the past month. Meanwhile, the S&P 500 gained about 0.9% during the same period. So why the underperformance? Investors seem cautious about the credit cycle, concerned that rising delinquencies could resurface in coming quarters if inflation persists and unemployment ticks higher. However, Zacks currently gives Capital One a rank number 2, buy, signaling expectations for market outperformance once earnings land. This makes sense when you consider the company's positioning, strong net interest margins, stable charge-off trends, and a diversified credit portfolio. In other words, even if EPS dips this quarter, Capital One could still surprise on the upside, particularly if management guides confidently for 2025. The broader economic read-through. Capital One's earnings tell a bigger story about the American consumer. If credit card revenues are surging 50+%, it means consumers are still spending. If charge-offs remain contained, it means they're still paying their bills. And if margins are improving, it suggests the banking system, at least for now, is handling high rates without breaking. So as investors, we should watch not just Capital One's headline numbers, but also its tone on credit quality and delinquency trends during the earnings call. What to watch on earnings day. Here's what investors should listen for when the results drop. Guidance for net interest margin. Will it stay above 8%? Credit quality commentary. Are delinquencies creeping up? Expense management. Can they keep efficiency ratio near 54%? Loan growth outlook. Is balance sheet expansion sustainable? Capital return plans. Any updates on dividends or buybacks? If management delivers stability on all 5 fronts, Capital One could rebound quickly, especially with a buy rating already in place. Investor takeaway. Capital One sits at the intersection of banking and fintech, and its results serve as a mirror to the health of U.S. households. Even with EPS expected to fall 6%, the company's revenue expansion and stable risk profile suggest resilience in both its model and the consumer base it serves. Yes, there are near-term pressures, mainly on efficiency and potential credit losses, but structurally, the company is positioned well for long-term growth in digital finance and credit innovation. For investors, this earnings report isn't just about one stock. It's a temperature check on the American wallet. That's it for today's PyUncut Market Breakdown. We'll be right back after Capital One's results to analyze the numbers and discuss what they mean for your portfolio. Don't forget to subscribe, rate, and share the podcast, and follow us for more deep dive insights on the companies shaping the financial future. Until next time, I'm your host, signing off.